Hello everyone. Welcome to our channel, Be More, where you could learn more about financial information and money management. So, today we are going to talk about the common financial institutions, like banks. Let's dive into it. Bank. At first, what is definition of bank? An organization which keeps money safely for its customers, the office or building of such an organization. You can take money out, save, borrow or exchange money at a bank. Types. 1. Conventional bank. Banks offer a variety of financial products, including savings accounts, certificates of deposit, and personal loans. Many locations can bank in person. 2. Online banking. Online banking is a digital platform that allows individuals and businesses to manage their financial transactions and access various banking services through the internet. Online banking is convenient and accessible, as customers can access their accounts 24/7 from anywhere with an internet connection. It also offers additional features such as e-statements, alerts, and automatic bill payments. However, users should be aware of the security risks associated with online banking, such as hacking and identity theft. Banks have implemented various security measures to protect customers, but it's also important for users to practice safe online banking habits by using strong passwords and avoiding public Wi-Fi networks when accessing their accounts. 2. Account types. Once you've chosen a bank, it's important to choose an account that suits your needs. There are many different types of accounts you can choose from, but here are some quick descriptions of some of the most common ones in India. 1. Current account. A current account is a deposit account for traders, business owners, and entrepreneurs who need to make and receive payments more often than others. These accounts hold more liquid deposits with no limit on the number of transactions per day. Current accounts also allow you to maintain a minimum balance that enables you to operate them. 2. Savings account. Savings accounts are bank accounts, where you earn a minimum rate of interest. Here, the number of transactions you can make each month is capped. Banks offer a variety of savings accounts based on the type of depositor, features of the product, age or purpose of holding the account and so on, so research these before applying for a new account. 3. Salary account. You can open a salary account as part of your employer's tie-up with the bank. As your salary is credited to this account from the day of payment, you can view your salary details on the dashboard of your account. If you want to change your salary account type, you can do so by logging into your online banking account and selecting the Change Account Type option. 4. FD and RD. There are different types of accounts that allow you to park your funds and earn a decent rate of interest on it. The most common include fixed deposits. A fixed deposit, FD, allows you to earn a fixed rate of interest for keeping a certain sum of money locked in for a given time, until the FD matures. Some banks offer a premature withdrawal facility, but if you use this facility, the interest rate on your FD will be lower than if you leave your money alone. Other options include recurring deposits. A recurring deposit, RD, is like a fixed deposit, FD. You get higher interest rates on RDs than on FDs, but you need to make regular deposits of a fixed amount over a specified period. Unlike a FD, which you can change the tenure or the amount every time you want, you can't do that with RDs. The maturity period for an RD could range from 6 months to 10 years. 5. NRI. Banks in India offer several different types of accounts for foreigners to maintain their savings in India. These include savings accounts and fixed deposits, NRO or non-resident ordinary and NRE or non-resident external accounts. Banks also offer foreign currency non-resident fixed deposit accounts. Let's take a look at these various types of bank accounts. 3. Understanding fees and charges. From January 2020, you'll be paying no charges for bank transfers through NEFT, National Electronic Funds Transfer, or RTGS, real-time gross settlement. The Reserve Bank of India, RBI, announced this change after its July monetary policy review. But this news may come as a surprise to customers who are not aware of the charges banks levy on various services. We list a few of them below. 1. Account maintenance. Banks levy account handling charges on cash deposits beyond a certain limit. Different banks allow different amounts of transactions free of charges, but most banks charge a fee for exceeding limits. If you're making frequent deposits at your home branch, expect to pay a small fee each time you exceed your daily limit by more than Rs 5150. 2. Lack of minimum balance. Almost all banks insist on maintaining a monthly or quarterly average balance in your savings account. For instance, State Bank of India, SBI, customers holding savings accounts in metros and urban center branches are required to maintain an average monthly balance of 3,000 rupees. The requirement drops to 2,000 rupees for customers in semi-urban branches and 1,000 rupees for rural branches. The bank charges Rs 515 for non-maintenance of the required account balance. 3. ATM, debit card, and checks. Banks are allowed by the Reserve Bank of India to charge customers up to 20 rupees per transaction at ATMs. The charges can vary, and SBI offers free transactions for savers in metro cities and non-metro cities. If you have an account with SBI, then you can get up to 8 free transactions per month, 5 at SBI ATMs and 3 at other banks' ATMs. You also won't be charged if there is a failed transaction. If you lose your ATM card, the bank will charge you a fee of Rs 5,500 to replace it. If you forget your PIN, you might also be charged for each time you reset it. RBI allows banks to charge only 150 rupees per check for speed clearing of checks worth over 1 lakh rupees. There are no charges for values up to 1 lakh rupees. If your check bounces, you will have to pay a fee of Rs 150. You will also have to pay a fee if you stop payment on a check issued by you or at your request. 4. Alerts. Text warnings were initially intended as a security measure to keep you cognizant of dealings occurring from your records. The objective is to instantly discern any instances of embezzlement. Nevertheless, this safety device has an expense. Banks typically inquire close to 15 rupees per 3 months for SMS alerts. 5. Fund transfer. IMPS transactions are still chargeable. The charge depends largely on the amount being transferred and the policy of the bank carrying out the transfer. 4. Reviewing your monthly statement. Your bank statement offers a detailed summary of your account's activity each month. It is important to review your statement in order to make sure that the information you have matches the records held by your bank. Contact them immediately if something appears to be off, as you could have fallen victim to fraud. When assessing your account, take notice of the summary of activity within it. This will give you an idea of how much money has gone in and out, allowing you to better manage spending habits and identify any potential fraudulent behavior. It is recommended that statements are reconciled each month for added security. For individuals who want to manage their finances, monthly statement reconciliation is important. This activity can help protect against identity theft, identify spending patterns, and create a budget. Businesses may want to avoid paper statements altogether and instead opt for electronic options in order to limit the risk of stolen information. Individuals should also remember that after their statement is reconciled, they must securely discard of it due to any personal data contained within.